Welcome to the BuyBox Experts podcast. We bring to light the unique opportunities brands face in today's e-commerce world.
Hi, this is James Thompson from the BuyBox Experts podcast. Today's episode is part of a special series of interviews that we have done to dive deeper into the recent phenomenon of private equity companies and FBA aggregators investing in private label brands that are leveraging the Amazon sales channel. As part of this series, we interview a wide range of investors, brokers, consultants, and entrepreneurs that have recently sold their private label brands. We peel back the layers on what's happening in this new investment space and look at how private label brands are finding financial success through the building and eventual sale of their online businesses. For 3 weeks, from mid-February through early March, we will release a new episode every weekday on this topic. Sit back and enjoy today's episode. Hi, I'm James Thompson, one of the hosts of the BuyBox Experts podcast. I'm a partner with BuyBox Experts and the former business head of the Selling on Amazon team at Amazon, as well as the first account manager for the Fulfillment by Amazon program. I'm the co-author of a couple of books on Amazon, including the recent book, Controlling Your Brand in the Age of Amazon. Today's episode is brought to you by BuyBox Experts. BuyBox Experts takes ambitious brands and makes them unbeatable. When you hire BuyBox Experts, you receive the strategy optimization and marketing performance to succeed on Amazon. We also provide investors with due diligence services. Go to buyboxexperts.com to learn more. Before I introduce our guests today, I want to send a big shout out to the team at Disruptive Advertising. For off-Amazon advertising, Disruptive Advertising offers the highest level of service in the digital marketing industry. Focusing on driving traffic, converting traffic, and enterprise analytics, Disruptive helps their clients increase their bottom line month after month. Check out disruptiveadvertising.com to learn more. Today, I'm pleased to have two guests on our podcast, Jason Somerville and Chris Shipferling, both managing partners at Global Wired Advisors, an investment banking services firm for digitally native enterprises. Prior to Global Wired Advisors, Chris spent 15 years in senior roles in sales leadership and digital marketing at various large consumer brands. Jason has almost 20 years of experience in investment banking, including executing capital market trades for Fortune 500 and Fortune 1000 companies and honing his skills that would later help him buy and sell both traditional and digitally native businesses. Chris and Jason, welcome, and thank you both for joining me today on the BuyBox Experts podcast.
Thank you, James. Thanks for having me.
Yeah, glad to be here.
So let's start by chatting about this big new wave of interest among investors looking to buy FBA private label businesses. The FBA private label business is a hot commodity today, and yet these businesses have been around for basically 20 years, as long as the Amazon marketplace. What do you see having driven all this local interest in the last year or so?
Well, I guess I'll jump in on that one first, James. We've seen this market evolve, much like many markets over the course of the last 100 years in finance. I think what you had for a period of time was the call it pervasive belief that someone selling products on Amazon was everything from a hobby or something quick that's just going to go away tomorrow, or is it really just a digital flea market? You had all of these, I would call it fairly pervasive viewpoints that, it wasn't necessarily a real channel for real companies and real brands to access. There was, again, the false view and maybe sometimes not so false in the early days that the sellers were all, kind of, again, individuals who are unsophisticated or foreign sellers, just kind of a general viewpoint that you couldn't really build a sustainable model that was utilizing, Amazon as a primary sales channel. And what happened over the last really 5 or 6 years is that thinking started to change. I think, as Amazon continued to have what we would call object permanence in a number of different markets as they grew their market share. What happened is people started to look at Amazon broadly a little more differently. It wasn't just that weird digital bookseller that Jeff Bezos started in his garage anymore. It was now this behemoth that was a force to be reckoned with. And then, as that, developed and these brands started to build, have real success, had multiple years of success, some of that, kind of sustainability and the belief that there was sustainability started to really develop. And so what we saw was, much like many other financial markets over the course of history, it started small, a handful of, people looking to purchase these types of assets. Valuations were very low. The view of risk was very high. And that's kind of just changed over the last few years. And I think it's got a long way to go from where it is. It's come a long way. But now you have, billions of dollars of sophisticated capital that are looking to invest in good consumer products, assets. And many of those assets utilize Amazon either, completely or heavily to reach customers. And so you've now seen, there's some real liquidity in the market. There's a much deeper buyer pool. You're starting to see valuations increase. All the things that you've seen, if you're a student of financial history, this isn't the first time this has happened. And, this is kind of how new markets develop. And we're seeing this in this case. And I think it's just kind of the early innings of it in our view.
So Chris, what do you think happens in the next couple of years as the number of investors continues to sharply increase?
Yeah, what happens? Wow, I think you're going to see more what we would call sophisticated capital pour into this space. I think we're going to see, in talking about financial history, and Jason, you can back me up on this, but typically what happens is you've got a lot of pioneers. It's usually VC that are the pioneers into a growing market and a growing space. And then over time, what you have is private equity has looked at all the mistakes, and then they come in and they learn from those mistakes, and then they really start to mature the market and continue to mature that market. So over the course of the next few years, I think you're going to see some failure. I think you're going to see some failure from these larger funds, some consolidation for sure. And I also do believe that you're going to see some corporate strategics get more serious about Amazon market share, and these private label businesses that have grown wonderful companies and wonderful brands that have a real chance to go omni-channel. I think they're going to get a real shot. And, that's obviously, as to Jason's point, where valuations go up. As by way of proxy, and I'll say this quickly, but 10 years ago when I was sitting around, Evenflow was a company that I worked at. It was, at the time, almost a $500 million company. When we would sit around the boardroom and we would go through all of the accounts, Walmart, Target, Buy Baby, see, even at the time, Sears and Kmart, if you can believe it, got a lot of love. And I was the one actually managing Amazon, and it didn't get love. And so, no one really wanted to have a discussion about Amazon because they were so, we were beholden to the Walmarts and Targets of the world. Well, now having still lots of contact in that world and a lot of other CPG companies where folks that I worked with at the time, and they've gone and branched out, I can tell you that's flipped. The conversation about Amazon is a more strategic conversation. It's about, okay, well, we're on vendor. Should we move to seller, right? Should we become 3P, and what does that look like? Right. That's becoming more of the conversation because, that direct handshake with the consumer is becoming more and more important too.
So let's talk about these sellers as a single group. Many private label sellers of all different sizes exist out there. Certainly, we've seen activity where companies that are doing, $1 to $3 million a year in sales, a lot of those companies have changed hands recently. When we start looking at much larger brands, and there are a number of these private label brands that do 20, 30, $50 million of sales a year, those types of acquisitions are much more complicated and not the types of acquisitions that an FBA aggregator is likely to do. And so you're looking at potentially having to bring in some of that traditional iBanker role or, large private equity. How do you see very large brands, guys that are doing over 50 million a year, how do you see them being able to exit? And I'll put one qualifier on that. A lot of these guys have seen smaller brands exit where the owners literally walk within 60 days. How does a guy doing 50 million a year walk within 60 days and sell his business? I'm curious,
Right.
As bankers, you're dealing with big companies. Tell me a little bit more of your thoughts on that.
Sure. I'll start with that one. Yeah, the short answer is that the process and the acquirer base are, different, quite frankly, in many respects for those guys. I think that, what Amazon has allowed, we talk about it, it's kind of its own ecosystem that's allowed a lot of brands to be born and to grow where they may not have, in another kind of world. And so now, the brands that are larger, they have a lot of options as this market is developing and becoming more liquid, and traditional financial sponsors and strategic purchasers will now look at these opportunities of 30, 40, 50, $60 million brand on Amazon and say, okay, first of all, that's real scale, right? That's got some real staying power. It's got some real heft to it. So, what can we do to acquire that brand and bring it on, usually to kind of an existing platform or existing strategy, whether it's a product category strategy, or even just kind of a broader digital consumer products, strategy, that they're very attractive assets because they've clearly, in a way solved the Amazon puzzle, at least for their products they have. And that is now seen as a very valuable thing. It's very valuable IP and very valuable, call it goodwill, that exists in that business. So these guys are going to look at it, on a much more strategic basis. Certainly willing to pay a lot more for that from a multiple perspective. I think that the point you make about exiting and walking, usually with transactions like that, there's going to be more structure. There's going to be a little more interest in keeping that owner, founder involved in the business, going forward. And there's really two things about that. Some of it's perception and some of it's reality. So these acquirers, for the most part, they want to believe that the founder, even though they may be wanting to exit for a variety of potential reasons, or exit control, if you will, that the founder still believes there's a lot of room to run in the business. And a lot of times they want that founder, if they're taking a very large financial risk on this company, they want that founder to sort of prove that by having some skin in the game. So they're going to be more likely to look for, say, an equity role, like retain 20% ownership or something. That's going to be much more common. And also, hey, you know what? We might want you to have a 2-year employment contract, as part of this deal. Now, if a founder, let's say they have a large brand like that, but they just really, really value just going off and doing a sabbatical within 60 days of closing, it's still potentially an option, but you're going to usually give something up to get that. You're probably going to have to give up some enterprise value to get that. And you're also going to have some explaining, really to do, and some convincing to do for those acquirers. Say, hey, why should we acquire this brand? Why should we pay $80-100 million for this company if you're just going to, turn off your phone in 60 days and we're never going to be able to talk to you again? That doesn't feel very good.
So let's talk about potentially smaller companies here. You talked about what Amazon has done to enable so many of these companies to be able to build, but it's not just Amazon. There's all this excess manufacturing capacity out there. It's easier for any random person now to get somebody to manufacture a widget for them. And so when you look at Amazon as a marketplace wanting to add new selection, cheaper, faster, better versions of products, Amazon inherently looks like the place for these entrepreneurs to flock to. So I'd love your thoughts around, as an investment firm, how do you grab that enthusiasm from all these different types of sellers? How do you leverage that enthusiasm and turn it into business opportunity for yourselves?
Chris, you want to take that one?
Yeah, and I may need a little bit more of an explanation on exactly how to try to do that. So if you could give me a little bit more commentary on specifically the enthusiasm.
So you have all levels of skill out there, operating as third-party sellers. Even if we just look at the private label sellers, there are very sophisticated businessmen and women, and there are folks that basically got on a plane, went to China to some conference. They met some people. They now make widgets and they private label them and sell them on Amazon. And you've got everything in between.
Yes.
And so as professionals that are involved in helping brands get more investment dollars and potentially exit, you have quite a range of options available there when you look at the types of companies you're dealing with. How do you segment the opportunity? How do you go after the parts that are interesting to you? How do you find the parts that are interesting to you? Tell me a little bit more about that aspect.
When we're assessing a company, like when we're looking at all the different businesses that we talk to, and kind of how do we leverage and pull out the enthusiasm and the opportunity of where this business might be going? I would say it's not simple, but at the same time, it's fairly simple. All that enthusiasm, all that sophistication should have resulted in a product that, frankly speaking, is unique or more unique, right? And so you do have a lot of sellers. You have a lot of folks that are going to Alibaba, and you have a lot of folks that are just putting widgets on Amazon. Yep. And frankly speaking, the result of that is commodity. That's what they built. And that's fine because they built cash flow. I think that it's getting increasingly hard to do that. The gold rush days of FBA back in 2014-15, I think it's not the same. It's a lot more expensive, in my opinion, from a capital outlay to really grow and scale a business through Amazon than it was 5 or 6 years ago.
Yep.
This isn't a shameless plug on you guys, but your role became much more important, in my opinion, than it was, say, 6 or 7 years ago, right? Being able to find a true, call it Sherpa, someone who can really take you through the advertising and take you through all of the optimization process on Amazon. Doing that in 2014-15 is wildly different now than doing it in 2021 and going forward. Some of that is just pure and simple TOS changes, right? So, for us, when we're assessing and we're looking and we're vetting a company that is wanting to go to market and is looking to take their business to market, we spend a lot of time on opportunity because that's really important. We spend a lot of time on what does the runway really look like, and being able to leverage, even on the smaller businesses, where is this business going to be in 3 years, right? In corporate America, this is done on enterprise level businesses all the time. In Even Flow, when I was there in my last enterprise business, we spent a lot of money on lots of very smart consultants to come into the business and work hand in hand with us to determine what a 3-year business plan looks like. Yep. We spent a lot of time there trying to identify what does this business really have in terms of true opportunity. And yes, the ones that have strong positioning when it comes to opportunity, they're going to gain a much better trade. They're going to get a much better valuation or enterprise value when it comes to a transaction. I hope I answered your question, by the way.
Yeah. So let's talk then. When brands come to you, they're not all equally ready to go to market. Mm-hmm. And that journey of deciding, yes, I think I'm interested in selling, to, okay, I'm actually ready now to start the paperwork and start the whole bureaucracy of having to deal with people and show them what it is that I sell and so on. I'd love to get your thoughts around, what are the series of discussions that your firm typically has with brands that might be interested in eventually selling?
Yeah, great question. And I'm always the first conversation they have running, business development and marketing for our firm as a partner. But yeah, it's really, in our firm, we play a lot of roles, and we play more than just, hey, let's sell your business today. Here's the paperwork and let's take you to market. Volume. That's not our game. Our game is much more strategic. So, kind of at an 80,000 foot level, there are several, clients of ours that we've taken to market, that we're currently taking to market, and that we will take to market in time, that we've spent 2 years with. So that's kind of at an 80,000 foot level. We like spending time. Well, what does that mean? They don't just want to call us to have casual conversations over coffee. Yeah. They need resources, and they want to understand, from our perspective, what resources are potentially needed that layer into an eventual exit, right? And, what might provide some more value. So, we spend a lot of time getting to know the company. We spend a lot of time getting to know the long-term goals, because that's also part of that intersection of going to market. what is the long-term goals of the founder and the owner of the business. And so, and part of getting to know the company, we're starting to really dive in from a consultancy perspective on functionality of the business, right? And really kind of walking through the different functions and really seeing where they may have some missing pieces. We get a lot of, smaller businesses for sure, larger businesses too, but not as much. We get disorganized financials. Well, clearly they need a not just kind of a mom and pop bookkeeper down the street. They need a real CPA to comb through, a real accounting firm. So we have a lot of vetted resources to get very specific. A lot of folks that we've spoken to, folks like yourselves, who we trust that and we also understand with our resources, the type of clients they're looking for, right? And so, we input their information and we output and send them to the right resources. And then along the way, we're doing, we'll call it check-ins, but they're more than just, again, kind of casual cup of coffee and how you doing. It's, hey, let's actually see where you stand. We have a client right now that we've been talking to for the past year and a half, and we're at a place now where we're about to do what we call a high fidelity valuation. We're going and 3 to 4 weeks diving into their business and truly understanding the company from soup to nuts, really understanding the companies from supply chain to logistics, all their operational leverage and how that's going to affect the pro forma going forward into the future. And we're going to provide what we call a time series analysis for these guys, because they really want to understand when is potentially the best time for our high growth trajectory, very large direct to consumer business to go to market. Mm-hmm. But we need to get a lot of detail in order to come to that conclusion. So I hope that gives you a little bit of a buffet of how we like to interact with our clients. It's a much more strategic approach.
I remember when I sold my first company, one of the challenges I had as an owner was figuring out what are the options on the other side for me. Yes, I want to sell my company, make a bunch of money, but there's a lot more to exiting than just getting a bunch of money. And so I'd love for you to talk a little bit more about when you said, what are the goals of the owner? I imagine there are a lot of situations where you talk to owners who have never sold a business before where they don't have particularly sophisticated goals because they don't know what goals are available for them to have beyond, I want to get paid. Mm-hmm. Can you take me through a little bit more around what are some of the types of goals that private label sellers, like the ones we're talking about today, what are some of the goals or the choices of goals they should be starting to think about?
Yeah. And, I'll give an answer, and Jason, by all means, feel free to give an addendum here as well. Sure. But when we are asking about long-term goals, number one, it's very specific to the actual exit, right? So there are a myriad of different responses that we get. One of which is, I want out. I don't want to work in the business anymore. Yep. I'm done. I'm burnt out. The day it sells, I'll give a little transition, but I'm done. Right. I'm on an island, right? 60 days from now, my phone's getting cut off. So, we've gotten that response. And of course we, as professionals, we walk them through that, hey, that may not be the best option. And here's why, but let's kind of formulate what that might look like. We have other, I just got off the phone with a potential client, sizable business, B2B, very diverse in terms of his revenue concentration. We're kind of walking through a little bit of what deal structure looks like and what it could look like. And he said to me point blank, I'm willing to go low on the cash at close if that means I have a lot of upside opportunity. Well, what he was saying and how it was interpreted was, I'm willing to go along for the ride to have a bite of that proverbial, next bite of the apple. Right.
Yep.
And so, so kind of after the exit and kind of talking through those things, of course, we play therapist and walk the client through, here's what you could potentially do once things are done. Once the transaction has gone through. Part of it is too, it comes down to non-competes. We have a lot of questions and conversations around non-competes and, what are they handcuffed to and what are they not handcuffed to in terms of growing and building? I mean, James, you work with a lot of folks that are a lot like the clients we work with. These guys are really, really good at building something to a certain point and then they're done. But they want to build something again to that certain point, right? That kind of first generation founder. So, Jason, do you have any addendum to that? Anything to add?
Yeah, I was just going to add one of the really actually quite honestly fun things about working with clients in this space is that usually we're working with founders. Usually those founders have a lot of entrepreneurial DNA, and you're right. Usually it's their first deal when we're working with them, and so we do end up talking a lot about, hey, here's kind of a path to how you do this again and again and again over the next 20 years, let's say, of your life. If you really enjoy building businesses and starting businesses in particular, there's usually two types of people. There's people that like to start businesses and people that like to buy businesses, that someone else already started. Usually you don't find a lot of people that are both. And so, we end up discussing that. And interestingly as well, a lot of our clients, there were a lot of years there where they didn't have a ton of capital to really devote in their business, and every dollar they were earning for the most part was getting reinvested. So, so they were always starved for capital. Well, they have one exit and they kind of fill the coffers. And we kind of, we have those conversations about, well, the next one's going to be a little easier because now you have a lot of capital you can devote to it. And so you can get that snowball effect over time and do it again 3, 4, 5 times until you're tired of it, and then go to the island.
So Chris, you talked about the going to the islands, but also you talked about getting your books in order. I'd love to have a conversation now around what are the sorts of things you wish more companies that came to you were already starting to think about or had already undertaken. To tell me a little bit more about that.
Yeah. In all 4 partners training, in our business careers, we've always been taught, know your numbers, right? And it's ingrained, at least in our heads. And I think, companies coming to us, as far as what I wish we had a little bit more of a better view or better picture when they come to us is really truly knowing the numbers, right? And what I mean by that is, not just your financials and your historical numbers, but really also understanding your data around all of your different metrics. Now, I know Amazon tends to gatekeep a lot of stuff, and it can be difficult to plug in, and that's actually getting more sophisticated, as you well know. And more data is starting to leak out, where sellers are getting a better understanding of their 3P business, but knowing their data, and then also really understanding where the business truly is headed in the future. That takes strategic thinking. And so I can't fault anybody because, strategic thinking takes, you have to take your head out of the weeds and you have to kind of rise above the clouds for a moment, right? And the only way to do that is to create more bandwidth. And I know a lot of these sellers just don't have that. So, while it's a wish list, I also know that it's a very difficult thing to demand from any of these private label sellers. But those are very helpful in formulating really strong, and we help, and part of our vetting process here at Global, we help formulate all 3 of those things, kind of understanding a better picture of your financials, understanding a better picture of your current metrics, your digital metrics, and then really also understanding a clearer picture of where the business is going.
So let's talk about where it's going, because if I'm a private label seller, I've got 10 products, 20 products in my catalog. Most of those are evergreen selection. I might add a couple products a year. I have manufacturers who make certain types of widgets for me, and I've got 2 or 3 of those guys that make those products. And I can take my business in a lot of different directions, but maybe this is I'll just make up an example. I sell pet supplies, and I know a lot about pet supplies in these particular sub categories. And so when you come along and say, well, tell me what the future looks like, what are the things that I realistically can look at without having to look into look into the future with crazy numbers? What can I do?
Yeah, I can give some simple, just very kind of simple, guidance on that. Again, I kind of go back to my own corporate history where, that was the question every year. We did budget planning. Well, that was one aspect. And we did, budget planning for the next year. Typically that started in August of the prior year. It was an exercise of about 2 or 3 months where we walked through every single key channel, and we walked through all of the different trade marketing that we would do and all the different sales forecasting, but it's about proper planning. So that's really kind of the theme. And what does that look like? Well, number one, product roadmap is a real thing, right? It's a real exercise in many consumer product companies where they actually take a look and go, well, where do I want the business to go? What am I really realistically going to launch and where am I headed, right? We just talked to a client, potential client that's now a client just yesterday, and we were really walking through that piece in function of his business was the product roadmap. He had a very clear idea of where he's going. Now he's a bit more omni-channel, so you're forced to be more driven towards a product roadmap when you're selling into Target and Walmart and Buy Baby and Menards and et cetera. You got to really think through, okay, well, who am I selling here and who am I selling here? And what, kind of what does that strategy look like? But, product roadmap helps with planning. That's number one. I'd say forecasting is another big piece, just really understanding where your business is going. I mean, we know that forecasts can get blown up very quickly when you have a growth trajectory, but at the same time, painting a clearer picture by SKU where this business is going. You have a better understanding too, where to allocate your resources, right? So Jason, I don't know if you have anything to add to that.
Yeah, I think it is. I think one of the things we spend a lot of time with our clients, on is that forecasting piece. It's most of them have never done it. Most of them have never actually done a 12-month, much less a 2-year forecast at the SKU level. Understanding, where new product launches are going to come in and kind of being pretty sophisticated and detailed about it. And I think the other thing is, one of the important parts as it relates to potentially exiting the business is acquirers want you to have a view, and because they're looking at your view as the most educated, most credible view. So if you come to the market and say, I'm not really sure where this thing is going to go, I'm pretty much fresh out of ideas, then that's not the message that you really want to send, because they're like, well, you're the guy who knows the business the best. So if you're fresh out of ideas, I don't know how we're going to do this. Yes. So I think having a view, and the view doesn't have to be perfect, and it doesn't have to be a crystal ball, but it has to be, and have some real intention and defensibility. One of the things we spend a lot of time on in marketing deals is defending the forecast, right? And that's what, we walk potential acquirers through the 2-year forecast that we've put together. And when they find out that these are forecasts that are built hand in hand with management down to the SKU level, they're like, okay. And then you explain how you got these numbers and their defensible assumptions, they respond very favorably. So, doing things like that is important. So have a view, have a roadmap, have an answer to, hey, if I gave you X amount of dollars tomorrow of growth capital, what would you do with it? How would you spend it in order to build this business and double and triple what it is today? Having an understanding to that level and having a view is important as it relates to exiting. And what a lot of clients find is after we kind of go through that exercise, they usually say, I wish I would have done that 2 years ago, because it's also another great way to manage the company with the right kind of viewpoint.
So I'm a brand. I'm looking to sell my business. I know I need to give the investor a roadmap of where growth comes from. Help me figure out when do I, as an owner, decide I'm going to do the growing myself versus I'm going to sell and let the next guy do the growth.
Yeah, I'll go ahead, Jason. You can go ahead. Sorry, okay. Man. I'll let you do it.
Yeah, I'll start there, and then Chris, you can jump in. So, I think it all comes back to the goals and call it goals and resources is really where it starts, right? So, we get a large number of clients that come to us, and they're pretty they're pretty humble about, what they've done, even though they're very proud. So we get a lot of clients that say, you know what, I've grown this business to this point, and quite frankly, I just don't think I'm the guy for the next, 10, 20 million, right? I doubt, I don't have the skills. I don't necessarily have the desire. and I don't maybe have the capital in order to get there.
Yep.
So now is a good time for me to exit and let the next guy do the growing, right? However, if a client says, to us when we first start speaking to them, yeah, I think I can double this business in the next 6 months, myself, right, with what I got. Usually we're going to say, you should do that, right? You should go ahead and do that. And then we'll wait and take you to market when you've done that. And so I think it's that intersection between goals, desires and capabilities that oftentimes drives that. And also usually feedback from us. If we're describing the market and saying, well, you know what, multiples really expand when your EBITDA starts getting north of 3 million and you're at 1.9, and you can get to 3.5, in the next 12 months, that might be well worth it for you to hang on for a while. And so, feedback related to those kinds of things also drives that. I don't know, Chris, if you would add to that.
Well, I would just, by way of example, I mean, we have a current client now that we're about to start prepping for market. I spoke to them mid last year. And I had that same conversation with them. They had a nice growing business. Obviously they saw the COVID lift, but it was not, it was sustainable and it was defendable. And, they were approaching about just close to about, I think, 1.8 million they saw as their run rate. And I said, look, man, you guys are, was very diversified, like 90% Shopify at the time, 10% Amazon. And I had that conversation with them. Hey, look, multiples expand when you hit a certain level. And let me kind of walk you through where the acquirer base starts to also grow. And just, on an educational, I'd call it, from an intelligent view of their business and when the right timing is to go to market. And for them, it was a little bit of a breath of fresh air. They spoke to some other folks who just wanted them to sign like today. And so, actually hearing some good advice, well, they just came back, to us about a month ago and said, yeah, you know what, we're done. We're ready to go to market, that does happen a lot where, we kind of walk them through all of their options and let them know where can you realistically take this business from an exit planning perspective and on a time series analysis too. I think that's really important.
So, gentlemen, when would I come to Global Wired Advisors to do business with you? When am I big enough? When am I too small? What's the sweet spot for your business?
Yeah, I think when you when you're about a year and a half to 2 years, and maybe a little bit less, but when you're really feeling that growth trajectory, driving towards $1 million in EBITDA, and you feel that, it's a good time to start having conversations with us. It's not a good time to necessarily go to market, of course, but it's a good time to start talking because, you said earlier, as the business is creating more revenue, as the business is creating more sustainable EBITDA and profitability, lots of complexity starts to get introduced into the business. I spoke to somebody just yesterday. They saw a huge lift last year. They're in home decor. And so saw a really nice lift. And last year, I think they did close to about, it was a stump year. So only 9 months, like 200,000, but they believe they're going to hit $1 million in EBITDA this year. And I said to them, I said, look, because they specifically asked, we had a great conversation. I think they really respected our view. And then, specifically said, what can I do right now to help? What advice would you give me right now? And I just, I kind of gave them a couple pieces, but I said, look, realistically, whatever I'm going to tell you today, it's moot. It's meaningless because once you start hitting that true trajectory towards that $1 million EBITDA, the conversation starts to change a bit. So we're happy to talk to people. I mean, kind of as a rule of thumb, we're happy to start having conversations with folks when they believe they're about, at the most 24 months out from going to market. And it's not just like you can't talk to us because of resource and bandwidth. It's more like we'll have a lot more things to discuss, once you're feeling that growth trajectory.
Yep. Anything else you want to add on that, Jason?
No, I mean, I think, I don't want to just turn it into an infomercial for us. I think in general, we just try to take a consultative and approach with people. We we want to be seen as a resource for this market. We want people that have questions and are considering, potentially selling their business, to see us as someone they can go to for good advice and good information. And so we don't shy away from it. We love doing things like this and just getting information out to the market. Mm-hmm. So we're not, we're more than happy to have certainly many more conversations, not less conversations. It's always more conversations. So, I'll just kind of leave it there. So we really, really like this sector, the Amazon ecosystem in particular. We love the people that we come in contact with. These founders are great. They're a lot of fun, such an interesting, diverse group of people. So we enjoy what we do. So, having these discussions, whether it's maybe a little premature or not, we're not going to shy away from it.
Right.
Of all the different types of companies you could be working with, you decided to be in this e-commerce space. I'm curious to hear from both of you. When did you realize you were good at doing what you're doing, helping brands position themselves for sale?
Yeah, I'll take it on more of the operating side. My career pivoted about 6 years ago, and I knew it needed to. I was at the time I was working for a company that was based in Barcelona. The business model was the traditional business model that I applied to every business that I worked in. I go to the retailers, I sell them product. Yep. I run trade marketing. I talk to them about their catalogs and et cetera, et cetera.
Yep.
I at the time when I was at this business, I was in between collections and I had about $500,000 worth of inventory sitting in my warehouse. And, I've been familiar with the Amazon platform. I've been working with Vendor Central since about 2004. They really put a strong emphasis on baby products and parents. They wanted that consumer, because that consumer buys a lot and stays with them for a very long time through their whole journey of life. And so I was familiar with Vendor, and my brother-in-law, actually, as soon as Seller Central opened up, and I can't remember the year exactly, he started selling on Seller Central. So I was kind of just, by osmosis, understanding a bit more about that side of the platform, but it was so young. I knew that I needed to get rid of this inventory. And so I really, really buckled down, and I became kind of one of that younger generations of guys who learned the Amazon Seller Central platform back in 2000, late 14, 15, and learned all about how to take all the keyword research that you do and apply it to the optimization on your listing, and then fumbling around with the advertising to get to a place where I actually truly understood it and it was making real impact. I think, my claim to fame is I got a booster seat, I think down to a BSR of, oh my gosh, it was like, I want to say like 12 in the baby category. And we sold out like that. It was pretty tremendous. So yeah, I knew then. I just knew that, from an operating perspective, I had to pivot. I had to pivot my own career and really start honing my skills in on that first handshake with the consumer. So that was Amazon Seller Central and digital marketing as well. So
Jason, what attracted you to this Amazon e-commerce space?
Sure. Well, it actually started, I spent a lot of years doing large deals for large companies, multi-billion-dollar transactions, and kind of that world of large, boards and a lot of, super sharky people and all that. And I decided a number of years ago that I kind of wanted to get away from that. And I really wanted to help, founders, figure out a way to exit their business. So it actually started more just broadly where, I decided that I wanted to shift my focus and help smaller companies in general. And then, seeing what was happening in e-commerce with the consumer and, the kind of growth that it was having and where I kind of thought things were headed, started to think about focusing more, in that arena, consumer, digital in particular. And Chris will tell you, I actually met Chris through another client that we had sold their company. And I sat down with him and I said, you know what, I think we can do a lot of good in this space. And, I know a lot about doing deals and a lot about breaking down companies. And Chris knows a lot about, e-commerce and Amazon, and said, you know what, why don't we start something that focuses on this? And there's so many entrepreneurs out there in this space that I think need our help and could use it, and we can do some good. And that's kind of how it all got born. You know, the Wall Street guy and the Amazon guy kind of got together and made an investment bank with other partners.
Right.
Jason and Chris, I want to thank you both for joining me today on the Buy Box Experts podcast. For those of you interested in learning more about Chris and Jason's investment bank firm, please visit globalwiredadvisors.com.
Thanks for listening to the Buy Box Experts podcast. Be sure to click subscribe, check us out on the web, and we'll see you next time.